Welcome to the NWR Virtual Resources Series. My name is Kerry Stevenson, and next up we have a keynote speaker, Karina Bader. She is an analyst with Acorn Capital, focusing on the NextGen Resources Fund, looking at what they're investing in and why. And if you've got any questions, ladies and gentlemen, put it in the Q&A panel at the bottom of the screen. And at the end of her presentation, we'll get to ask some questions. Karina, great to see you. Looking forward to your presentation. Over to you.
Thank you very much, Kerry. Lovely to be here today and talk to your viewers. So Acorn Capital, this is our disclaimer. Obviously, every presentation must have its disclaimer at the very beginning before I get into the meaty bits. So for your viewers who may not know, Acorn Capital was founded as a boutique investment house over 20 years ago, and it was invested on the belief that the emerging companies sector was highly inefficient, and there were a lot of outsized gains to be made in the industry. And it was founded by Barry Fairley, who was a resource analyst formerly and a mining executive. Acorn itself has always had a dedicated resources and energy team investing in the space. David Ransom, who many of you may have heard or met, was initially the portfolio manager. I started over 12 years ago at Acorn and was joined by Rick Squire over 5 years ago. And we've all been geologists with financial experience and background, and we're backed by a strong executive execution team who helps us out executing. NextGen itself was established in September last year after a strong inbound interest from clients looking for a dedicated resources fund. Acorn Capital's point of difference is that based on our 20 years of sector learnings of investing in this space, the institutional memory that we have, and the unmatched industry IP and data that we've developed over that time frame. So what is the opportunity and what is it that NextGen Resources is looking to invest in? Look, we recognised early on that there was this global transition to a low carbon economy underway, and that was going to result in increased demand for commodities used in electric vehicles, renewable energy and storage, and those commodities that are particularly exposed to that transition are commodities like lithium, rare earth elements, nickel, copper, cobalt, and graphite. And we have invested in all of those commodities over the 20 years at Acorn Capital, and we love them, and we can really see the next 10 years is going to have a big demand over that decade.
Karina, in terms of those commodities that you just mentioned, is one more of a standout than another? In other words, you know, the nickel price is strong, the copper price is at all-time highs, and then we've got lithium. But do you focus, like, are they all your favorite babies, or is one more of a standout?
It is a little bit like they're all our babies, and it's hard to find one that we favour over another, but it is a timing issue often. And I will talk to that a little bit. I'd say of our most favoured at the moment, they're all our favourites, but our most favoured, it's like having children really, is rare earth elements, mainly because it's such a limited supply pipeline for those elements. Now, rare earths is a little bit of a misnomer. It's not actually that rare earth to find deposits. What is tricky is actually extracting it and getting the battery grade quality that customers are looking for. So rare earths are used in wind turbines and high strength magnets, and also in electric vehicles. But there are significant processing issues which can occur. And there's two core deposits, what are called ionic clay deposits or carbonatite deposits. And they each have a different processing route, and obviously based on that, a different capital requirement and timeline to first product. And so one of the things that investors need to be aware of, it's a great commodity to invest in, but look at the underlying asset. And our view is that there are quite a lot of technical challenges with these deposits. So one of the benefits you get in investing in NextGen is our technical expertise as geologists, understanding those technical challenges coupled with the financial skills. And you could say the same about all of those commodities. Lithium used in batteries, look, that's had a really great run, as you've said. Commodity prices escalated rapidly over the last 12 months. And, you know, in reality, for the NextGen Fund, our key contributors over the last 12 months have all been lithium producers. And you've seen some consolidation in that space now. And what you're looking at, if you move out of the big producers and you look at the new developers coming through, they are based on some very unique deposits like clay lithium deposits or lepidolite deposits. And they actually have a new process flow sheet in order to get those, to extract the commodity for customer needs. And again, they're unproven, it hasn't been done before. And for us, that sort of tends to say, be more cautious, take a bit longer to do the work you need to do to decide if you want to be invested in those particular assets. And nickel, not so much from a processing technique point of view, but there's only a few developers and producers that you can actually get into to get exposure to nickel. And again, they've been re-rated recently over the last 12 months. But some of those deposits actually aren't suitable for battery grade nickel at all. So investors need to be aware of that when they're looking at the nickel space. And then if we move on to cobalt, used in batteries, it's a key element. But in reality, as a mined product, it is a byproduct of nickel and copper production. So there's no actual single asset cobalt mine.
Oh, I didn't know that.
And the reality is the majority of the global supply of cobalt is coming out of third world jurisdictions, which have significant sovereign issues. And again, so investors need to be aware of what exactly is the underlying asset they're investing in when they're looking to get exposure to cobalt. Copper, there are some large producers of copper globally that you can get exposure to as an investor, but there's actually very few down at the small end of the market. And again, they often tend to be polymetallic mines, which means they produce not just copper, but they produce zinc, lead, gold, and silver. And so with that comes metallurgical complexity. And obviously that has a flow-on effect to both margins and the capital required to extract value out of those investments. Graphite itself is actually not rare at all. And there are many deposits globally with graphite in it. But what we have seen is that the producers have really struggled, again, to get that high battery spec product that the customers are looking for. And so again, shareholders have to be really careful and have some technical understanding of the asset and what kind of products actually going to be produced by that company in order to get the right returns for them. So just to reiterate, Kerry, we love all of these commodities. Rare earths is probably our favourite at the moment, but they've all got a strong demand profile over the coming decade. But we think investors need to have some technical skills when they're looking to invest in each of those.
And so I guess that's why your NextGen Fund takes that away from investors. You don't need your technical knowledge. Leave that to you guys. You go through the technical stuff and go, okay, project A is good, project B not so good. So they can be rest assured that you do the hard work and they invest in the fund, basically.
Thank you, Kerry. You've just summed it up perfectly. We've got a database with over 7,000 assets in it, and we've got projects that are globally located geographically, but also on different exchanges, whether it's the TSX, AIM, other exchanges, and unlisted as well. We have a huge pool of unlisted assets that are in our database, which we've built up over 20 years. And one of the real opportunities investors in NextGen can get is access to that proprietary knowledge, which normally only institutional clients get access to. And we use that daily, every minute really. And anytime a new asset comes to us, we can put it very quickly into our database and we can decide quite quickly on where it sits and ranks compared to all of those 7,000 projects that are already in our database. And we believe that that allows us to make quick decisions around its overall value and whether we need to do a deeper dive. And yep, this has got good, we can see a good opportunity here. So we're going to spend more time and go and do that detailed DD that we will look to invest in. So we've just talked about our favourite areas.
My favourite commodity, Karina.
But I know this is one that's deep to your heart, Kerry, is the gold opportunity. And look, we still love gold as well. And it's as you'll see later on, I've got a slide to talk to this, about 20% of our funds are still invested in gold. We really see that gold is looking very undervalued at the moment, but there are some pressures emerging for the mining industry in gold in particular. You know, oil prices rising, wages pressure, shortage of technical skills. So there is pressure on margins for these gold producers, but we really still see there are some really undervalued gold assets out there, and investors should certainly also still be looking to invest in gold. And another part of the market, which has probably been very unloved for quite a long time, is energy. And it's not the majority of our investments by any means, but we do still feel that there's been significant underinvestment in supply of these products over a long period of time, the last 5 to 10 years even. And you can see, obviously, the oil price and the gas price. And we're talking about a potential gas crisis in Europe. What we've seen is as COVID has we've become unlocked from COVID and demand has started to grow back for these commodities, there's really been a structural undersupply or an underinvestment in new supply for these commodities. And I think that that's what's driving those prices that we're seeing recently. And uranium, of course, it's quite a controversial commodity. Some people love it, some people hate it, but it does seem to be finding its place in the low carbon economy, especially for countries that have large emission reduction targets like the US or EU. And a sort of realisation is occurring that we may not be able to reach these emission reduction targets by 2030 without incorporating uranium into the mix. And again, you've seen the uranium price rise recently. So these are two pie charts. And what you can see on the left is the composition of the commodities that you can get exposure if you just invest in the ASX 100. And what you'll see there is the majority of your investment, if you were investing in the top 100, would go into iron ore exposure. Whereas on the right-hand side is the commodity composition of the outside 100 stocks on the ASX, but greater than 10 million market cap. And so this is the universe that NextGen Resources is investing in. And the key takeaway here is the size of the EV metals exposure that we have in this space. And we also have exposure to uranium. You've still got good quality exposure to gold and other resources, and iron ore as well, if you wish to be exposed to that. In addition, we've got over 600 companies that we can look to invest in versus 18 in the top 100.
Wow.
So from our point of view, the potential diversity, the opportunity to get direct exposure to each of those commodities we previously talked about is a much greater opportunity in this universe than at the ASX 100 level. So taking all of those things, how do we look to invest then in an individual stock? So what we use as part of our underlying philosophy is what's called the Lynas curve to help us assess potential investments. So on the x-axis on the bottom there, you can represent project advancement from early exploration to discovery through to development and into production. And on the y-axis, we see a representation of a company's market value as it goes through those different development stages. And as you can see from that curve, there are two key areas where a company tends to be re-rated by the market. One, obviously, is the discovery stage, which is always very exciting. And then the other stage is as a project moves through from development into production, and then obviously cash flow and return to investors. But what generalists may not understand is if you look at the middle of that curve where there's an actual decline in value, that's what's called the study or the development stage. Now, this is where companies go through scoping studies, PFS studies, or DFS studies. All of that takes time and working capital. You've got environmental approvals processes, you've got mining applications processes, and all of that comes together to basically extend. You've got no control as a company on those timelines. It's dictated to you by government regulation, and you just have to do the work to meet those requirements until such time as at the end of the development stage, you've got a project, you've deemed that it is economic, it is viable, and now you've got to go raise the money to get that into production to generate that cash flow. So Pierre Lassonde actually developed this, and he was the founder of Franco-Nevada. And he used those three development stages we've talked about there, exploration, development, and production. But at Acorn Capital, we've actually broken that out into 9 different stages. And we think that that's a real point of difference for us versus all other investors in this space. And we have an allocation policy based on those different stages of development, as you can see in this chart. And so that really leads us to how is the NextGen Fund looking at the end of September. And the chart on the top shows you 32% is invested directly in EV metals commodities, but we've also got 13% in copper and 5% in uranium. So if you add those 3 commodities up, we've got 50% of the funds directly invested in that EV renewable storage energy space. We've still got a fair proportion of gold at 22%, and we tend to hold a bit of cash because there's always new primary raisings occurring. We always want to make sure we've got a bit of cash to invest in those as those opportunities arise. The bottom chart there, our Lassonde curve, look, 20% of our funds are invested in explorers, which is made up of 13 different companies. By market value, obviously, the largest exposure we've got is 37% in expansion phases 2 and 3. and that's over 12 different companies. So that gives you an example, or it tells you how our NextGen Fund is currently invested in the market. Environmental, sustainable and governance issues are also really important to us, and we have institutional investors and it's kind of top of mind constantly. Right now we're going through AGM season, so it's even more relevant right at this point. But what we know is that by investing in the companies that we've invested in the NextGen Fund, we have a significant impact on sustainable development goals, which your viewers may be aware of, which is a sort of a United Nations Sustainable Development Goals Pact, which is aiming to achieve outcomes by 2030. And it's made up of 16 different core criteria, but the ones we really impact on with our fund are affordable and clean energy, sustainable cities and communities. We impact on poverty, believe it or not. Obviously, with our EV exposure, we impact on climate action. But our companies that we invest in also impact on decent work in the local communities that they are operating in and economic contribution to the countries that those projects are built in. So, of course, the really important piece for your viewers is the performance of the fund since inception. And this is post-fees, all costs incorporated. We've delivered 50% over the past 12 months to the end of September. And that's outperformed all the other relevant benchmarks in the marketplace. If you'd invested $50,000 at inception last year, you'd be walking away with $70,000 or more this month. I'd like to reiterate, though, this is a wholesale fund only. And so that concludes my talk, Kerry. Open for questions.
Karina, thank you very much for that. And I tell you what, ladies and gentlemen, it's better than keeping your money in the bank, because at 0% interest, what's the point? I like that 50%. Congratulations. Well done.
Thank you.
Ladies and gentlemen, if you want to ask a question of Karina, please put it in the Q&A panel at the bottom of the screen. Karina, my question to you while they're still thinking is, are there any jurisdictions that the fund won't look at, like some of the, like the DRC, or do you look at the globe and think, well, we like Australia and certain jurisdictions, but we won't touch others?
Look, I am very reticent to ever say no. So basically, our first principle is always look at the asset first. So every asset we come across will go into our database. We do have a risk weighting for different jurisdictions. So we do try to mitigate some of those risks around those sovereign risks in the actual quantitative part of the process, which we go through. We don't have any strict no-go zones, but clearly there are certain jurisdictions where we think the risk is a lot higher, and we'll give them a much higher risk weighting, which ultimately brings them down the ranking in terms of whether we'd be interested in investing. In reality, the NextGen Fund, over 50% of it is invested in assets that are in Australia. And then the next largest investment geographic region is North America and South America. But we also hold a significant part of our funds in East Africa as well.
You mentioned at the start rare earths as one of your favoured children, not your favourite, just one of the favoured ones. Can I ask you just to expand on that a little bit? How many companies have you invested with rare earths? And rare earths as an investment, is it quite tricky to understand it from a technical point of view? And that's why for investors, if they're looking at exposure to rare earths, your NextGen Fund could be quite a good way to get exposure.
Yeah, look, I think if your investors have looked at this space before, everyone has sort of looked at Lynas as, and look, it's done extraordinarily well, and our fund has been invested in Lynas, and we've done well out of it over the last 12 months. But if you'd invested over a decade ago when Lynas first made its discovery, and then if I go back, if I can go to the slide, the Lassonde curve, when Lynas made that discovery, it shot up to over $1 billion in market value as a discovery. But then it almost went bust back in 2014-15. And the only reason it didn't go bust was because its debt providers gave them an interest-free holiday. So if you'd been an investor along that whole journey and you stuck with it to where it is today, you still would not have made your money back. So it's a salient lesson is these projects are complex. They take a lot of capital. It took a long time for Lynas to get the processing right to get to the product that it needed to sell to its customer. In addition, the uranium and thorium issue I raised previously is well publicised in the general market in Malaysia as being one of the core problems that they've had to face over time. And that's fundamentally why they've brought that cracking plant back to Australia and building it in Kalgoorlie, is to eliminate that storage handling issue for them. It also allows them to double their production line in Malaysia, which will allow them to double that finished product that they can sell to customers. So it does two things. But it is that is a carbonatite asset, which the rare earth is located inside the monzonite molecule, which also contains uranium and thorium. So when you crack that molecule to extract the rare earth, at the same time, you're also getting the uranium and thorium, which then is look, it's a very low grade. It is, you've got as much in your kitchen benchtop, if you've got a granite benchtop, as what they're producing. But obviously it is a materials handling issue. Whereas there are other deposits called ionic clay deposits, where the rare earth is actually located on the outside of the molecule, and a very weak acid can actually strip it away and convert it into a rare earth product that can be sold. And that is part of the reason why China is the largest producer of rare earths globally, because the majority of their assets are ionic clay assets. Now, in NextGen, we actually invested in a company called AR3, Australian Rare Earths, which we believe has discovered another, it's an ionic clay asset in South Australia, in Australia. And we invested in that pre-IPO. At the very, if you look in this chart, the startup stage, which is probably our earliest investment ever at Acorn Capital. We don't tend to go into startup, but we tend to go into early stage one. And then we've been in it since its IPO, and it's out there trading, and it's had a really strong performance. I think we invested in it about 3.5 cents, and now it's trading at about 80 cents.
That's a good win. That's a good win. Well, funnily enough, I've got a question here, which is, do you have a favorite uranium and a favorite rare earth? Well, I think you've just answered the rare earth because you said AR3. That's probably a rare earth fave for you guys, given where you invested and where it's gone. What about in the uranium space?
Yeah, look, and it's really interesting, the uranium space. There's quite a number of stocks. So if I go back to our commodity composition, there are over 27 stocks in the universe that we look at, which are uranium focused. And they're actually a legacy from making discoveries over a decade ago before Fukushima, and the real downturn that's occurred since then for uranium. And so there are clearly assets that were in production previously, which then were put on care and maintenance. And our view is that those are the assets that are likely to be turned on first, both from customers who've already bought their uranium previously. So Paladin is obviously one of those. So they're familiar with the product. They know that it can be produced and at what quantities. And so our view is the buyers will obviously go to the ones they know first.
Yeah.
But then you've got companies like Boss Energy, which is in South Australia, uses a different technique to extract its uranium. It initially got into production, built its asset, but had to get shut down because the processing route didn't work. And this again is part of this issue around technical issues.
But they've solved that now, I think, haven't they, Karina?
They have solved that, and they've raised their money, and essentially they're just waiting for the utilities to come to the table and ask for offtake before they turn that on. So again, we think they're one of the next cabs off the rank. And then you've got new discoveries, and one of the most advanced of those would be NWR Resources. And that is in Western Australia. They got their approval in 2016. Obviously, approval for any new uranium asset is incredibly problematic. So our view is if you've already got a mining license approval, you are streets ahead of anyone else who might make a uranium discovery today, but it could take over a decade to get that into production. So they're not going to be making cash flow for over a decade.
And that's a key point. These things can take a lot of time, and excuse the pun, a lot of energy.
So we try to use this Lassonde curve to recognise, as I said, where that company is at in its stage of development, and therefore how much to be invested in it, and then whether we need to take that money off the table given where it's at and what the likely outcomes are.
Karina, we're out of time, I'm afraid. It's been fantastic to see you. You've got a wealth of knowledge. As you say, you've been with Acorn for 12 years now. A lot of knowledge there, ladies and gentlemen. So how can people get a hold of you or get involved with the fund if they would like to?
Look, acorncapital.com.au is on the web, and we have all of the prerequisite requirements and application forms for NextGen on our website at Acorn Capital. Otherwise, I'm on LinkedIn, And even on our website, you'll be able to link through to me and send me an email. We have many ways to access. Just Google Acorn Capital in Australia, not the US.
Yeah, make sure it's Acorn Capital in Australia, ladies and gentlemen. Karina Bader, so great to see you today. Analyst with Acorn Capital. All the best with the NextGen Fund. It looks like it's going to be an exciting ride. Cheers.
Thanks very much, Kerry. And thanks to you viewers.